Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. Of course, we are continuing our way up in this massive euphoric rally that we're seeing. We believe that we are in the last phase of the bull market, and that's when you get the largest price movements. That's when you get the overheated sentiment, the speculative price action. We're following all of that very closely on this channel. You've got most valuation indicators going absolutely off the charts. This is equities as a percentage of total assets. The total stock market cap is now 200% of GDP, higher than any moment in history. And you've got indicators like the rule of 20 here. That's been an accurate indicator of PE ratios for the past 100 years. You take 20 minus the CPI, and that tends to give you a relatively accurate measure of PE ratios. So PE ratios are the valuations of the stock market. How expensive is each stock relative to its earnings? And you can see there's one brief period where PE ratios went off the charts relative to this rule of 20 minus CPI, and that is during the dot-com bubble. And the second period is right here in 2021. So we are clearly in some type of speculative bubble. And that's part of the reason why we think that we're going to continue to see some crazy moves heading into the end of the year, because the stock market is no longer grounded by valuations. That's almost the definition of a speculative bubble, that price no longer respects the underlying fundamentals. Of course, we're following this very closely on this channel, so if you're interested in finding out more about what's happening in the financial markets and where we're going to be heading, make sure to smash that subscribe button. Now, this video is going to be focused on the timing of all this. When is this euphoric run that we're seeing going to come to an end? A lot of investors are concerned, scared of buying into this crazy market, scared of holding in this crazy market. So in this video, I'm going to tell you exactly where I think the markets are going to be topping based on quite a few different indicators. Hopefully that's going to answer some of the questions that we had in the comments section from the last video. Now that I've gotten this intro out of the way, let's get right into it. The first thing that I want to do in this video is take a look at the US dollar index. It's been a while since we haven't taken a look at that, and this is a great indicator of whether the markets are risk on or risk off. You've got a rising dollar environment, you tend to have a lot of pressure on equities. But when the dollar is weak, that means investors are exiting their cash positions and going into riskier assets like equities. So of course, recently we've had this rise in the dollar that sparked a lot of fear in the markets. That's part of the reason why we went from 56% of investors being bullish to only around 30% of investors being bullish on the stock market because of that rising dollar environment that we had. Now, if you were watching our videos throughout this period, you'll know we kept a relatively bearish outlook on the dollar with clear areas of resistance here that we just did not see the dollar breaking through in the current macro environment. If we zoom out to a daily chart, you'll see the large divergences we had between the price that was heading higher and the RSI that was heading lower here. That's a divergence in momentum as we were approaching this big zone of resistance. So we expected this move to eventually reverse. And if we jump back to an 8-hour chart, you can see we're currently breaking down this bullish structure that we had. We had a nice price channel that acted as support throughout this period. And here you can see we had a test and then breakdown. That's what's happening right now. We're attempting to break that down. Now the battle on the dollar is not quite done. If I clone this trend line here and try and find another line of support, you can see it catches these reactions very well. So I do believe this is probably the last big line of resistance. If we extend that, right, let's extend that to see where it is, and it coincides with this zone of support. So that could still be an area where we see a temporary bounce in the dollar before eventually breaking that down and heading lower. But what we're seeing right now, this breakdown in the bullish structure, is telling us that the markets are still risk on, right? We're not seeing a risk off move in the dollar. In fact, if we take a look at the euro US dollar, right, and this is pretty much the opposite chart of the DXY. So the US dollar currency index, one of the big components in the DXY is actually the euro. And so when you look at the euro US dollar, you're basically seeing the inverse of the DXY. But on this chart, you can see what we had throughout this period, a nice head and shoulder pattern. A lot of people, a lot of deflationists were getting very excited about this pattern. And then we broke down here below this trend line here. That was a breakdown. But look at what just happened here. A nice snapback above this level. This is now a bear trap, and this is a bullish structure, right? So this is giving me a lot of confidence in a weak dollar. If we have a strong euro, DXY is going to be going down. The next big level of resistance for the euro is around here. So we have quite a little bit of room to run before we get into some tough resistance on the euro and begin potentially seeing a stronger dollar. I really, really like the setup here. Big bear trap and even a break above this line of resistance here. That's beautiful. Make sure to smash that like button if you're enjoying this video. If you're finding these videos useful, don't hesitate to take a couple of seconds to do that. It helps our videos out so much. So that's the summary of what's happening on the euro and the dollar. We expect a weak dollar. That should be a great environment to see equities move up higher into the end of the year. Now, if we pop back under, maybe the deflationist will be right and we'll be heading much lower on the euro, higher on the dollar, and then we'll get that big stock market crash that everyone's expecting right now. I don't think we're going to get that just now. I think that's going to be later in the year. I'm going to talk about that in just a second. Now, one more interesting chart that we retweeted on Twitter was from Macro Charts here. This is their core US equity model. Now, of course, we're not basing too much of our strategy on this, but it's interesting to see that this model that's been pretty accurate at timing quite a few bottoms over the past 2-3 years is now oversold again, despite the markets heading higher, right? So I think they've got a good handle on this. Don't underestimate how far this rally can go. Now let's take a look at when this risk-on move might be coming to an end. Now, before I do that, I want to quickly answer a question that we had in the comment section of the previous video. Jeff was talking about the fact that the market is as risky as it has ever been, and it's going to continue going up. So how does a rational person invest in that type of environment? And that's exactly why one of the focus points that we're trying to bring to our website on gameoftrades.net is how to invest in this crazy type of environment. We're coming to the end of a period where we've had low and sustained levels of inflation. That's the red line here. Low and relatively stable inflation throughout the past 20 years. And we're coming out of that. And I do believe that the COVID crisis precipitated that. But we're now coming into a period where we're going to see some pretty wild moves, whether that's big levels of inflation or even deflation. I think that's a very real possibility. But from an investing standpoint, that complicates everything. I think stock market returns are going to be lower over the next 10 years than they've been in the last 10 years. I think bond returns are going to be negative over the next 10 years. So your typical stock to bond portfolio is unlikely to be very successful in the environment that we're going to be coming into here. So the target audience that we have for our website is really young investors who want to understand what's happening with the financial system and take advantage of it with a portfolio that takes advantage of those currency debasement trends. And that's why the two center points of our research is gold. That's historically the best hedge for this type of environment, and cryptocurrency, so Bitcoin, whose entire movement and really the beginning of Bitcoin stems from this narrative of currency debasement that we're going to see. I post frequent updates on both gold and Bitcoin, looking at everything from the technicals to the macro to the sentiment and putting all that together to give you guys our clear convictions. And of course, that's only for $29. I don't believe I've seen a subscription site that provides this much value for this little money. So when is this risk on move that we're seeing going to come to an end. If you watched the last video, you'll know we discussed this chart of J&K divided by TLT that basically gives you risk on versus risk off moves, right? This is very important to understand. When J&K is outperforming TLT, you're basically in a risk on environment. Investors are willing to take high yielding risk. But when TLT is outperforming, that's when you know that investors are going into safety assets like bonds, like cash. So based on this chart, we have a very, very simple chart on the log scale showing you this downwards trend line, showing you that we've been risk on since March 2020 all the way till March 2021. A full year of being risk on. Here we're seeing this consolidation, and we eventually expect to hit that trend line for one last big risk on move heading into January 2022. Now, if we put the 10-year yield, I showed this chart as well. All of these big peaks correspond to big peaks in yields. So that would suggest that, as we've been saying, we're going to see a move up in yields here heading into the end of the year. And why is that important? I'm going to show you. This is the chart of the 10-year yield. We're going to put up the S&P 500 on top of this chart. And just over the past 20 years, I'm going to show you the periods where yields went higher. That was at the end of the dot-com bubble here between 1998 and 2000. That was right here between 2003 till 2007. That was a rise in yields, rise in the stock market. That was between December 2008 and March 2010. Very strong stock market throughout that period. Then again, another great example was between June 2016 and this top here in September 2018, right? A big move up in the stock market. Stocks and yields tend to move in the same direction. So if we see one more big move up here in yields heading into the end of 2021, into this zone of resistance, this is the point where bonds are going to become an interesting investment. When you've got 2.3% interest on your 10-year bond yield, and you're comparing that to a stock market that's in bubble territory in terms of valuations, in terms of sentiment, and just incredibly overextended, you're going to start to see smart money and pretty much all money go into bonds instead of stocks. Now, again, that's if we see this move up in yields. We still need to watch what happens over the next few months. But if we have that risk on move that we're talking about, this is where we'd be looking for that move to reverse. And you can see that's some pretty big line of resistance here. We've been in a massive disinflationary market since 1982. And we built that zone of resistance throughout this entire period. So our target, our end of year target for yields would be at around 2% here at that lower range of that resistance. And of course, as you hit that resistance, you're going to see the Federal Reserve begin tapering aggressively because inflation is going to be hot, but yields are going to be on fire. Most assets are going to be on fire. And that's when we could see a major move down in yields into the zero range right here. And we've obviously got S&P 500 seasonality on our side here heading into year end. October, November, December, those are the best months to be in the stock market. You're going to see COVID-19 cases begin to peak, at least in the US, and probably begin coming down significantly throughout the months of October and December. That's going to bring so much confidence. You know, those are our convictions. Tell us what you think in the comment section down below. Now, hopefully this all gives you some type of a timeline on all this. I hope you guys enjoyed. If you did, make sure to smash that like button as hard as you can. Now, in the meantime, I wish you good luck on your trading and see you next time.